Hi class. We're going to look at problem 31 on page 730 in chapter 7. It reads, Gopher Corporation reported taxable income of $500,000 this year. Gopher paid a dividend of $100,000 to its sole shareholder, Sven Anderson. The dividend meets the requirements to be a qualified dividend, and Sven is subject to a tax rate at the preferential rate of 15% on the dividend. What is the income tax imposed on the corporate income earned by Gopher and the income tax on the dividend distributed to Sven? So just a quick refresher, the corporation is reporting taxable income of $500,000 and they are distributing a dividend to their sole shareholder in the amount of $100,000. So we're going to look at how that affects the tax liability owed to both the corporation and to the individual shareholder, Sven himself. And we will contrast this when we look at the next problem, problem 32, and how this being classified as a dividend versus it being essentially income, how does that affect the overall tax picture for both the corporation and the individual? So here, they're going to owe tax at the corporate level, at the entity level. That corporate tax, remember for C Corps, they are taxed at a flat 21% rate. Now the issue is, what do we multiply by? In this case, because that dividend or that distribution to the shareholder was deemed a dividend for tax purposes, that is not deductible. So they will be taxed on the entire $500,000. So on that $500,000, they're going to owe $105,000 at the corporate level. The shareholder, because they did receive a dividend as opposed to a distribution of income or a bonus, as we'll see in problem 32, the shareholder is going to be taxed on that distribution they received, but at the preferential rate of 15%. So overall tax, total tax owed between the two entities will be $120,000. And again, the reason being the corporate tax rate of 21% and the preferential dividend rate of 15%. Now we're going to go contrast this to the next problem, problem 32.